Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsarthi, and in this podcast, we take you through what are all the happenings in the bond markets in terms of where the levels of yields are and what kind of returns investors can expect in their for their investments if they buy into the bond market or invest in any kind of fixed income product now, given where the yields have moved over the last 1 week, and what is it where could they best position their portfolios as well. So in this week, clearly we saw very sharp rise in GSEC yields. The budget presented to the parliament on the 1st of February saw the government showing very high borrowing program, and including states, the borrowing is very high, and the bond markets are worried about the supply. And the 10-year GSEC yield went up to well over 2 year kind of level highs to 6.95%. And across the maturities, all the GSEC yields went up very sharply. Even the 5-year GSEC yield went up to 6.2%. Even the state development loans yields went up well over 7.2%. And so clearly, when GSEC yields move up, one is even corporate bond yields have to move up because GSECs are the risk-free assets as the government is issuing the paper, and any bond that is issued by non-government entities, including PSUs, even though they are owned by PSUs, they trade at they trade over the GSEC yields or levels. And if you take the Bharat Bond ETF, which is an ETF of all PSU bonds owned by the government AAA rated, which is a reflective indicator of where the PSU bond yields are. The 10-year Bharat Bond ETF went up to around 7.18% levels to 7.18% to 7 levels. The spreads are very low to the 10-year government bond yield. And the market is still not sure whether the yields can sustain at higher level. That's why the spreads are still compressing for the PSU bonds. And if you take the private sector, and even the 5-year Bharat, 4-year Bharat bond yield is at over 6% levels, and all that 6.2%. And even the private sector bonds, if you take AAA rated bonds like HDFC and LIC Housing Finance, the long-term bonds are well over 7%, while even 3 to 5 year bonds have gone up to around 6.2% to 7% and over kind of levels for all these bonds. And even the NBFC bonds have also started to react to them, but only the high yield bonds, which is the bonds that are closer to 9 to 10%, they have not reacted much because anyway they were trading at very high yields, and they're all short maturity bonds, mostly in the 1 to 2 year papers. So we have like it, um, uh, microfinance companies like Swatantra and Ashirvad and others um, trading at closer to 10%, while for 1 to 2 year papers, while for others like you have 3 year papers of companies that are slightly higher than uh, that are rated higher, like Shriram Transport and others, trading at over 8% levels for 3 year papers. And for even for 1 year, you have some papers like Aadhar that is just over 1.5 years, that is around 7.3% levels. Aadhar Housing Finance. This is a AA rated paper. So these are some of the levels that are there in the market. And in the private placement market, we are seeing corporates come and issue bonds. Adani Green is issuing bonds. Then you have um, NABARD that has issued bonds. Luckily, these are all big issuers of bonds. And in the and in the MLD space, you have Shriram Transport, you have Avendus, and you have Vivriti Capital, all of them coming on to issue bonds. So most of these bonds are all in the 1 to 2 year maturity, maximum of 2 years, because there is no appetite for longer term bonds. So clearly, investors are now have to focus on investing in a rising interest rate scenario. And in this, some of the strategies are including uh, investing in staggered maturity bonds. Some of the state government guaranteed papers like UPPCL have staggered maturity bonds maturing in say 6 months, even and 1.5 years. And when staggered maturity bonds, they pay off they pay the principal in equal installments. And so when the cash flows comes in earlier or in periodically in next 1.5 year period or even 1 year period, then the investors get to use the cash flows to reinvest at higher levels because interest rates are rising. And otherwise, you have bond ladders that are again gaining popularity in non-INR bonds, where our bond ladder portfolios have been well embraced by investors, financial advisors for their clients. So they invest 1, 2, 3 year or within 2 years, um, 6 months, 1 year, and 1.5 year bonds, or different levels and different yields and different. And so these bond ladders, what they do is, if you identify the right bonds and position your portfolios accordingly, then you get higher returns, which is inflation beating, as well as you get the cash flows faster, and all these cash flows can be reinvested on in a longer maturity papers as interest rates rise. So bond ladders are also a good strategy to employ in rising interest rates. And as usual, MLDs, which are, as many investors see them as a tax arbitrage, they are also gaining a lot of popularity. And they also, as mentioned, the private placements, many MLDs will also be starting to issue now as more and more corporates rush to the market to raise money before interest rate starts to rise very fast. So that's what investors are doing. And clearly, we have the best bonds for you in Quick Invest by INR Bonds app. All you need to do is download the app on iOS and Android devices and look at the bonds, click on the invest, and then it will see all the information that you need to see, including our own proprietary risk score. And it takes you straight to the investment, and you can just invest in the bonds with a one click solution. Or just download the app now. And if you are listening to the app on YouTube or any other Spotify or Apple podcast or Amazon Music, then please do uh, subscribe to us and recommend the podcast, and as well as use the like button. And if you can give reviews, that will also be very helpful, as INR Board is trying to throw more and more information to investors for them to take highly informed decisions into the corporate bond investments. Thank you for listening in. I'm Arjun Patsati signing off.